Morning. Hope you had a good weekend. Monday the 11th of September. Just getting stuck into the briefing then, and despite the pretty amazing scenes that we've seen from Florida, from the Hurricane Irma hitting, obviously causing great devastation in that area, the actual markets this morning have been relatively calm, and what we're looking at here is a situation where, in summary, the actual weather system itself, actually the center of it missed Miami, which is obviously one of the most densely populated areas, and that in combination with the fact that we were anticipating potentially another missile test from North Korea on Saturday, that did not occur, and so these kind of dual factors, if you like, have seen a bit of a repricing in a kind of mild relief, I guess, across the assets this morning at the open. So consequently, you're looking at both stock futures markets opening higher, the DAX Euro stocks on the front foot, and T-notes then and Bund seen lower, gold gapping down. We're down about $11 in the yellow metal as well. So again, it's kind of situation obviously not great from the 3 million odd people currently without power on the Florida Keys and so on and so forth, but certainly this hasn't been as bad as the markets were expecting, and as such, hence then this kind of relief rally that we're seeing this morning. Whether or not this can last is a bit questionable, because generally speaking, relief rallies are much like the kind of human emotional response. Relief tends to be fairly short-lived, and I'm sure will return to some normality as the session progresses. Just looking at the DAX here, obviously you've got the kind of around the high that we printed, that would have been, I guess, Thursday, providing a bit of support here on R2 on any pullback. Kind of opened just above there, came close to moving back towards that level before just edging back up higher again this morning. Quick look then at this story. A lot of people have been talking about now what type of damage are we looking at, and despite numbers being very inflated, i.e. the costs of this could be extraordinarily high. I mean, I saw one report suggesting 300 billion. I think that's way up high on the top end. But wind, water raging on, but one estimate has sunk to 150 billion. So certainly this situation there not being quite as devastating on that side of things as we were anticipating end of last week. You can see here the path of the actual hurricane itself and where it's heading, and so Miami obviously is situated kind of more on the eastern side here, so it did actually miss that, moving along the western coastline, then going into through this week Mississippi, Alabama, Tennessee, Kentucky and into Indiana is the current projection. So I'm sure you've not heard the end of Hurricane Irma for this week's commentary. What does this mean, though, for economic growth in the US, and does this really disrupt? I had Will message me over the weekend thinking that he had struck gold in saying that, has the Fed been blown off course? There you go, Will. I did say your pun. You owe me some money. But what we're looking at here is Goldman sees hurricane curbing US growth, but only for a quarter. So what's happened here is that Goldman Sachs, they've cut their estimate for US third quarter growth by 0.8 percentage points. But it said it could drop by as much as 1%. The important thing here, though, is that the next 3 quarters will get a boost from recovering consumption, inventories, housing and energy. So whilst, I mean, if we have a look at this chart here, post-disaster rebound, what US output loses due to hurricanes, it should make back in subsequent quarters. So although there should be a fairly significant impact on growth in the US in Q3, irrespective of the fact that that hit is getting more larger on an average basis of what the banks are anticipating, the recovery is still seen to be fairly positive thereafter. What does this mean for the prospects of the Fed and what they're going to do in December? Well, really it hasn't altered things too much. A December rate hike, as you can see here, priced by Fed Fund Futures, 36.2%. There were some comments a few people were picking up on from Esther George, who will be a voter in 2018. She said we'll need to move interest rates to more normal levels. It's time to continue to move the interest rate higher. It's not an attempt to tighten or slow down the economy. The committee is committed to a very gradual approach, and I think that is appropriate. Keeping in mind George does tend to be one of the more hawkish members, but irrespective of some of the fluctuation we've seen on this from when payrolls came out, then when North Korea did their nuclear test, we've kind of swung between 40 to 30%, so we're sitting around the midpoint of that at the moment. So all in all, the kind of market pricing hasn't changed that drastically as yet. From a Fed commentary point of view, don't forget we are now into this week, the blackout period, before we then get the Federal Reserve interest rate decision in the coming week, well, next week I should say. Looking at the other story, this is the one where no news is good news in regards to no missile test occurred on Saturday, as was hinted towards in the middle of last week. However, North Korea warns US of greatest pain if sanctions pass. So just having a look at the actual story here, North Korea warning of retaliation if the United States, or United Nations, excuse me, approves a US proposal for harsher sanctions after Pyongyang conducted that sixth nuclear test. So the warning comes after the US are calling for a vote today on a draft resolution to tighten sanctions on North Korea. So something we can just keep an eye out for, probably post that UN vote, depending on the outcome. Then for what does Kim Jong-un have to say post that decision? Could be something of interest, but likelihood that won't come until later on this evening, then going into the overnight tomorrow morning session, I would imagine. Other news to be aware of, you've had Chinese inflation data. This came out over the weekend. For any of the interns, if you're not used to the normal routine, Chinese data does come out on a Saturday on a quite regular basis, particularly the CPI numbers. Inflationary pressures emanating from the factory to the world is proving more resilient than economists had anticipated. Producer price inflation accelerating to 6.3% in August from a year earlier, exceeding all but one of the 38 analysts who were surveyed. So this is what we're looking at here. You can see the white line indicative of the producer price index, the CPI level, a lot more more consistent comparative to the quite wild fluctuation that we've had. Keeping in mind we were at -6% at the end of 2015, all the way up to +6.3, whereas the CPI reading's been fairly constant around that just around 2% level. Global metal prices soaring last month. China's demand held up on robust investment and construction amid government reforms that may push down on supplies, is what helped that PPI number squeeze higher, is what's being touted. Another headline that caught my eye yesterday was this one, and it doesn't really fly too much against the current kind of wind, if you like, in reference to what Russia was saying last week. Saudi Arabia also saying a similar thing. Al-Fali discussed with his Venezuelan Kazakh counterparts the possibility of an extension of the global oil supply cut pact beyond March of 2018. So OPEC and other producers, including Russia, agreeing to reduce output by about 1.8 million barrels. So this is the existing agreement until March. But they're talking about a further extension of at least 3 months beyond that point. And this is really going to be discussed when they have their regular meeting in November. How has this translated really into the oil price? Hasn't really had too much of a reaction. Some people have pinned that on the reopening of trade that we've had, kind of around this 47.50 price crept up in Asia trade. Some people have talked about this Saudi comment from the weekend, but you can see we've already given back a little bit of that as Europe has stepped into the marketplace. But overall, just looking where we are to where we were, I guess, at the beginning of last week, net we haven't really gone too far, despite the run up in prices that we did have in the first half of last week. We've given a lot of that back really on Friday's session. But we do sit in mild positive territory, up around 25 cents at the moment. Just having a look then at the calendar for today. It is particularly quiet, as you can see. There is really not a great deal going on. We've had some comments out of ECB's COA earlier. Said there is a compelling international evidence that non-standard policy measures have been successful. So really just talking up the ECB's present and past strategies. Nothing really new, forward-looking in that respect. But one thing to keep in mind for today that's not on this calendar, because economic data, there's really not a great deal that's going to spark the market into life. You do have the UK House of Commons. They're holding their first vote on Prime Minister Theresa May's flagship Brexit legislation. There's been a couple of reports in UK press talking about the ability and disruption that could come of that if opposition parties should so wish to disrupt the process. But that might be interesting. Don't really see it being too much of a risk event if you're a sterling trader, just something to be aware of. So that is happening today. Looking ahead to the actual week though in its entirety, you can see Monday by far is the most quiet day. Things do get more interesting from tomorrow from a scheduled perspective. And in particular, I would have some interest to see how UK inflation is going to come out. If we just have a quick look, tell the journey of UK inflation, which has kind of fluctuated from 2.9 to steady out at 2.6% more recently. You can see here on the chart. Question is where are we? Well, where are we at present in August? Have we continued to stabilise at 2.6, or was this a brief hiatus before another push on the upside back in towards 3%, which will obviously start to put additional pressure back on the Bank of England on potential rate rises. Let me just flick my screen. This is what I was looking at, the 2.9%, the 2.6 here steadying out. Now looking at cable, I was looking at it on a slightly longer time frame. Last week obviously we had a pretty decent push on Friday. First time in a while we've seen some economic data really more indicative of actually people are spending. And there was a report, if you remember, about, I think it was the REC and KPMG survey talking about new starters' pay was the highest it's been in 2 years because of a labour shortage, basically. So people are starting to get paid more because EU citizens now not having confidence of coming to the UK under the uncertainty on what their deal would be going forward. And so actually cable, to the detriment also of the dollar, of course, which is generally, although it's up this morning, has been on a weakening path. We have got up to those highs that we were printing right back at the beginning of August. This is when we were knocking on the door of a 133 handle. And if you start looking at cable, obviously in a bit more of a longer time frame, that level there would be very significant on the upside if we were to get up to test that at any point this week. We're about a point short of there at the moment, that 132.87 that you can see. Any move above there, the next kind of big level starts coming in at 134.5 and 135, because then that's pretty much the highest we would have been post the day of the EU referendum. As you can see then, that was that big downward move that we had on that night, which prior to the actual referendum itself in February of 2016 was when we were trading down at around 138.34. So irrespective of a lot of uncertainty, it seems, about UK politics, the actual currency pair does continue to remain pretty robust for the time being. So that data is coming out on Tuesday. As you can see here, UK inflation, core inflation, of course, important. And we'll then get the OPEC monthly report. This has been more market moving more recently. Historically, I'd say it probably isn't so much, but the context of the compliance levels, the global demand situation, and how much Saudi are kind of carrying the load of adhering to this compliance deal is been quite influential for the price of oil. Moving further forward into Wednesday, you get the latest job situation in the UK, but we kind of know the deal with that. In terms of the unemployment rate, not so significant. What is significant, obviously, is the measurement then of more on the inflationary side, given this negative real wage situation that's been apparent for the last few months in the UK. So that figure will be particularly important. But then this starts to lead us on into the more interesting data from a US perspective. And that really is when we get into Thursday, when we get the inflation rate out of the States. Because with the Fed looking fairly divided between the confidence and conviction they have that the tightening labour force will eventually equate to higher inflationary pressures, where inflation goes in the short term is going to be really critical to the hopes of them executing on this September balance sheet tightening and a December rate hike. Looking at core inflation in the US, this is what it looks like at the moment. Obviously, we've seen a persistent fall from 2.3% at its most highest at the beginning of the year, all the way down to now being a steady 1.7 for the last 3 months. Now, to put this in a bit of perspective, obviously 1.7 looks quite a bit lower than the pattern that we were seeing through much of 2016, where the Fed probably would have felt much more comfortable on this measure about tightening of policy. If you start to put this chart back a bit, if we were to drop down to 1.6, let's say hypothetically, with the data that's coming on Thursday, then you're talking about the Fed having to make tightening decisions with inflation, what would be at this level, only 0.1 lower than it is at the moment. It's lower since 2014. And so it's really going to put the pressure on the hawks and what is actually the current communication line from the Fed, whether they can follow through with this. Obviously, as I said, going into blackout period, not going to hear from Fed members going forward, so you're going to have to wait till the actual event occurs itself to hear what the statement is and how they have summed up their assessment of inflationary conditions. You've also got on Thursday the Bank of England interest rate decision. Don't think really I'm expecting any fireworks from this. I'm sure that Saunders and McCafferty won't want to lose face and will continue to buck the trend of the majority and continue to push for a rate hike. But again, from a sterling point of view, something to just be aware of. You've also got the Swiss, the SNB interest rate decision as well occurring on Thursday. And then on Friday, to wrap things up, you've got the European balance of trade, US quite busy again, retail sales, Empire, IP, Michigan. So really second half of the week for North American data is when things start to heat up a little bit, with the Bank of England and the SNB also occurring on Thursday. Your inventories for the oil markets, as per usual, still assessing the Hurricane Harvey impact with those data sets for probably for the next coming weeks as well. And that pretty much sums up your week. So not going to talk any longer than that. The main point being that we got a mild relief rally this morning. Hurricane Irma, although has caused wide-scale devastation in the local area, as far as markets' expectations were concerned, it hasn't been quite as bad as feared. This in combination with a fairly calm few days on the North Korean front, where they did not fire another test missile as they had indicated they would at the weekend, has helped further lift some of the sentiment, hence the gap up in equity futures lower than in fixed income and gold, as well as weakness in the Japanese yen, reflective of that unwind of kind of the flight to quality that defined much of last week. Just a quick look at gold, just to close things off. Looking here is when you had the gap up in gold prices when North Korea conducted that nuclear test. You can see that we are just at the moment, this morning, we've found some support around S2, but then you move below here, you've got Wednesday night kind of going into Thursday overnight session support at 1336. We did briefly manage to close the gap on Tuesday, or Monday actually, last week, for them recovering. But obviously some levels here downside to keep an eye on. Okay guys, going to leave it at that. So have a good day, have a good week. Any questions? As ever, I'll be available in the chat room. Thank you very much.